Hello, everyone, and welcome. We know several people are still joining, but I'll go ahead with our introductory comments. Thank everyone for joining us for this special live broadcast. My name is Josh Newton, and it is truly my honor to serve Emory as the Senior Vice President for Advancement and Alumni Engagement. As our daily routines are significantly impacted with physical distancing, Emory has developed a robust set of digital experiences to strengthen connections within our Emory community during this critical time. The presentation you are about to hear is part of our ongoing digital learning program, sponsored by the Office of Alumni and Constituent Engagement. We are focusing efforts on bringing lifelong learning to a variety of digital platforms to meet the needs of our alumni, students, parents, donors, and friends. Two pieces of housekeeping while people are joining. This presentation is being recorded, and we will be sending the full recording out later this week to everyone who registered. Second, while we received a number of questions in advance and have already shared those questions with Rick, please type any questions you may have during the presentation in the question section of the platform, and we will get to as many of them as possible at the end of Rick's presentation. Now, today we are incredibly grateful to be joined by Rick Rieder, esteemed 83 BBA alum and member of Emory University Board of Trustees, where he serves as a member of the Finance Committee and is Vice Chairman of the Investment Committee. Rick also serves on the Emory Guazetta Business School Dean's Advisory Board. Rick is the Managing Director, Chief Investment Officer of Global Fixed Income, Head of the Global Allocation Investment Team, a member of BlackRock's Global Operating Committee, and Chairman of the BlackRock Firm-Wide Investment Council. Rick oversees the management of $1 trillion in fixed income and multi-asset portfolios. Before joining BlackRock in 2009, Rick was President and Chief Executive Officer of R3 Capital Partners and spent the prior 20 years at Lehman Brothers. He served as Vice Chairman and member of the Borrowing Committee for the U.S. Treasury and is currently a member of the Federal Reserve Bank of New York's Investment Advisory Committee on Financial Markets, the Alphabet Google Investment Advisory Committee, and the UBS Investment Advisory Board. Rick was awarded the Global Unconstrained Fixed Income Manager of the Year for 2015 by Institutional Investor and was inducted into the Fixed Income Analyst Society Fixed Income Hall of Fame in 2013. Rick, our sincere thanks to you for joining us today. I'll turn it over to you.
Great, thanks, Josh. Thanks everybody for doing this. And by the way, it's also nice doing this virtually, or part of it doing it virtually, because usually when people mention the Fixed Income Hall of Fame, nobody understands what that is or why there even is one. So I usually get giggles when that's announced in conferences. But anyway, thank you all for letting me do this. It's always an honor to speak at Emory. I do a lot of presentations, but it's it's a thrill to do it with your alma mater, and so I much appreciate it. I hope everybody's doing well and safe and healthy. So I thought it would be interesting. I hope you find it interesting. I did this presentation a couple of weeks ago that had a crazy number of thousands of people on it, just talking about markets and the economy. And we're going through what is the most extraordinary period in time. I literally believe this, having gone through the crisis in 2008 and other periods that were under duress in the markets. This is one of the most extraordinary ones I've ever seen from a variety of perspectives. One is how unbelievably unpredictable this was, how fast it came on, and quite frankly, how uncertain the future is on the backside of this, both economically and across markets. So I'll touch on some of that. I use a lot of data in my charts. I will try not to. I know there are people in finance and people outside the finance world, and I tend to drift into technical terms, and please be patient with me if I get into too technical. So let's go to this first page on here. So let's talk a little bit about a series of graphs here. Just to put in perspective, by the way, the title of this presentation was "Believe It or Not," sort of like a Ripley's "Believe It or Not." That some of these things are almost unbelievable in terms of how they played out. First is, I don't know if you can see this on my chart on the upper left. This is the nature of, this was the fastest decline in the S&P 500 that we've ever seen. Took 28 days, leaving the Great Depression a distant second. Just show you the duress in the markets that we saw over what was an incredibly short period of time. If you look at the second chart, on the top. The peak to trough move has been more than any prior episode. And I'll show you some more data on this. That is pretty incredible. On the upper right, in one of the more eerie comparisons, I actually started my career. I graduated Emory and then went on to Wharton. And I worked for SunTrust actually at the time in Atlanta before that. And I started in 1987. And this chart is was pretty eerie in terms of how much we followed 1987. By the way, stocks where you'd have to multiply by 10 in terms of the level of stocks because of obviously the capital appreciation, but pretty extraordinary in terms of where we are. By the way, this chart again, I did this a couple of weeks ago. Oil this year topped. The oil prices we're at $66 and they went to 19 this year. Again, I did this 2 weeks ago. Oil is about to hit 10, which is a pretty extraordinary. Sorry, it's now under 10. It's a pretty unbelievable setup. I mean, think about at oil prices. I talk about this later. That less than a movie ticket for a barrel of oil. It's just unbelievable stuff. And where we've seen the long bond, so the 30-year Treasury moved in a 33-point or 70-point round trip move. And I'll talk about this in a second about what the Fed did and interest rates around it. Just to put this more in perspective, to just show it graphically, what we saw in the last few weeks in the markets was like a decade of price movements, literally. When you look at both on the stock side, and we show the days in the last 1 month, the S&P 500 made a plus or minus 4% move. And by the way, this was again 2 weeks ago, and we keep doing it almost every day since then. It is extraordinary. By the way, there's one great stat that I didn't put in here. This was as of a week ago, and it's obviously still more true today, that if the S&P 500 did not move, the price did not move, it sat static right now, today would be the most volatile year in history. So think about that in April, mid-April, that if we didn't move, that just shows how volatile it is. And then on the upper right, same thing on the bond market side. When you these are days where the long 30-year Treasury moved in plus or minus 4-point range. And on the bottom right, I show the absolute. If you just took the absolute change, just to show you, this chart goes back 20 years ago. I would just show you, because we don't have bond prices further back than that. Nobody can believe this. I mean, this is, you talk about stress. I think Josh cut off my asset management, what I manage. I'm responsible for a little over $2 trillion in assets. And to think about, the stress level when you go through that sort of volatility. If you go to the next page, and by the way, so now let's talk a little bit about the ramifications of it. I'll get into some of the economic and some of the sensitivities we've run around the economy. If you go to the next page, when you go through these periods of panic and uncertainty like you're seeing today, what ends up happening is people just scramble. We call the market the dash for cash. People just want to raise cash because they don't know what they're supposed to do with their investment portfolio. And I show on the on the top left, is money flowing out of bond funds, both global bond funds, US bond funds, money flowing out of treasuries in the top middle, money flowing out of corporate bonds on the top right, money flowing out of equities on the bottom right, and then obviously juxtaposed to this, money going into money market funds or bank deposits. Just as incredible. I don't know what to do. And by the way, the uncertainty around the duration of time before the economy reopens, just as get me into cash as opposed to any other asset, has been the most extraordinary phenomena we've seen, I've ever seen, or anybody's ever seen. Anyway, before I transition, I just want to talk about on this next page, just to show you where some of the markets, just to show you how incredible this is, particularly for market junkies like myself. So what I put on the right side, so if we look at the 2-year Treasury yield, at the end of the year, the yield on the 2-year Treasury was 157. It's currently at 12. When I did this last night, it was 21 basis points. It's now, I added this chart yesterday, it's now under 20 basis points. The 10-year Treasury went from 192 all the way down to 65 basis points. We're at 63 basis points now. And then some of the others that are pretty incredible show you where we've gone to. Mortgage-backed securities, and went from at the year end where about 2.5% went to one where they are today, just over 1%. I just want to throw out one thing, and I don't know, not to take too long in terms of this presentation. Mortgage rates at the time actually were going higher because of initially long discussion about the Federal Reserve did to bring down mortgage rates, but now we're at levels obviously extremely low. The municipal bond market was incredible, and I know I've had a lot of discussions with policymakers across Congress, the administration, the Fed. And one of the things that was really dangerous, and still today is somewhat dislocated, is municipal bonds. In particular, when you think about how states and local municipalities have to fund a number of these programs and the loss of revenue that they have in the interim. So the municipal market went at year end from 163. On March 23rd, it was at 332, and then the Fed has started buying or put a program in place to buy municipals. That market has stabilized, although I would say that market is still a little bit, depending on state, as you would imagine, places like Illinois or New Jersey or Connecticut, still pretty dislocated. I'm going to skip some of the structured markets, like I know people know CLOs or commercial mortgages. We're a long discussion about in commercial mortgages, places like that, where you don't know what the real estate market is going to look like. We do a lot in commercial mortgages, from hotel to office property to multifamily, and the uncertainty around those spaces is high. You just don't know. We've been in the mode of urbanization in the big cities. How does that evolve? So that market is still a bit dislocated. And then finally, on the bottom, without going through all of this, the equity market, which I'll talk about in a second, as people know, it peaked on February 19th at 33.86, went down to 22.37. Was that about a 30% or so decline? And then has since come back to 2,800, actually sitting at 2,840 today. I actually am pretty blown away that the market, and I'll talk a little bit about how we're thinking about investing around this and throw out some ideas around it. Okay, so let's get into a bigger picture around the economy. So why is the market so dislocated, or the market so dislocated? Some of this data is pretty incredible. When you look at these charts, you look at this top chart on the upper left, what came from Open Table. That shows bookings on Open Table that are obviously at zero now. You look at hotel occupancy rate. We compare this versus different years, and you look at the red line, and this was as a couple of weeks ago. I assume that this just keeps going down. Then we took peak morning rush hour time. I have no idea why San Francisco, when we did this, actually was up. I assume that was. Not sure what that was, but obviously the dynamic there. You look at movie theater, box office receipts, et cetera. And then the charts on the bottom. Jobless claims. When I did this, jobless claims are at 3.25 million, and I think the number we got last week was over 20 million. I mean, this is, you talk about, in markets. Sometimes the markets are cold and data heavy, but I spent a lot of time on the phone this weekend with policymakers and donating a lot of money. This is it's an incredibly difficult period of time for a variety of reasons. The unemployment rate, we think, is going to peak in this country. These are some estimates from Goldman Sachs, Credit Suisse, and JP Morgan. We think it peaks in and around 12%, probably ends the year at somewhere between 7 and 8%. GDP, we think, is going to trough quarter on quarter. You could have a down 30% or so. Some others have actually a bigger number than that. But then we think growth will pick up into the third quarter, something like 12%, and then maybe 8% in the fourth quarter. It's so hard projecting what that V looks like. And the hope is it's somewhat V formed as opposed to a U, because you don't know how deep the descent is going to be, because it's just so hard predicting when the economy is going to reopen, which I'm going to talk about in a second. So let's go to the next page. I want to hit some more economic things that we did. And so I think the reason why this presentation got so much following is we ran a bunch of a lot of data. I'm known for putting more data and charts on a page than is humanly possible as a environmentally friendly to save ink or print. But if you look on this page, when you look on the left side, I just want to put in perspective the hiring in the U.S. If you go back, and I'll just talk through what I put in the middle, there's been 19 million jobs created since 2010. It was actually been the most extraordinary growth of employment that anybody's ever seen. But when you break it down, and then I broke it down to try and think about what happens subsequent to this. So if you think about what happened in places like retail being shopping stores, department stores, et cetera, obviously the growth there hasn't really been that significant in terms of hiring. Obviously Amazon being significant in that regard. And then you go down and let's just do this quickly without hitting all these numbers. 100% of the job gains that we've seen in the last 10 years have come from three categories: professional services, education and healthcare, and leisure and hospitality. Pretty unbelievable dynamic. So the point that I want to make here is the service sector has been all the growth of hiring in this country. There's a long story about, we give a lot of presentations on technology and demographics changing the world. What's happened is we've moved from what is still the most successful manufacturing economy in the world, but the global economy has moved somewhat away from manufacturing to the service sector, and all the hiring has come in the service sector. So then we try to extrapolate that onto where are we going. So what we did is we looked at 2008 to try and think about what happened in 2008 as some microcosm or some representation of where we could go from here. And you look at what happened in 2008, and you think about these sectors. Healthcare obviously didn't slow at all in terms of the growth, and you would think, obviously, in the dynamic we're faced with today, it's hard to believe that healthcare is not going to be a growing field, particularly the amount of stimulus dollars that have gone in that space. Places like accommodations and food services is what gets into leisure, or is categorized by the way BLS categorizes it as the leisure. That obviously that area is going to have a severe impact today, and then you would hope would start to come back over a period of time. And then government, which has been a big hiring area, is an area that we think that you'll still have some you won't have much of a slowdown in hiring. So point being is I do think that while you're going to see this hit to employment in the near term, if you try and extrapolate that out over the coming weeks and months and couple of years, you would think that a lot of these areas are going to come back. And I would argue, and what's so tough, including things I went through with policymakers this weekend, there are going to be some jobs that are going to be lost. There are going to be some, some companies are going to take a long time to get back to the workforce they had before. And I'll talk about the stimulus on the backside of that. But you would think that the U.S. economy, by the way, it's really different than the rest of the world. Places like the emerging markets, Europe, have a hard time with that bringing employment back, I would argue. U.S. is a much more resilient, vibrant economy than much of the rest of the world. Anyway, if you go to this next page, not to spend too much time on this, I just want to put in perspective and try and bridge the economic conditions to the markets and talk a little bit about why I think markets have come back, and particularly equity markets have come back while we still don't have any closure on the reopening of the economy. What markets tend to do, and I would argue markets maybe overshoot oftentimes, but what we did is we ran the impact across different industries without going through all these numbers. And we took the impact across industries, the number of jobs affected, and then we made some assumptions in terms of how many weeks that people would be out, from 4 weeks to 6 months. And then we assumed there will be about, there's going to be about 50 million jobs missing on average 11 weeks of work. I actually would say we'll probably push that number a bit larger today, maybe a decent size larger than that. But then we put on that, we said, okay, what is the income lost? And it was about, at the time, it was about $450 billion. I would argue it's probably a bit bigger than that, however. But I'm going to show you some numbers in a second. The fiscal stimulus that's come in, and more coming in this week. Presumably the Senate and House are going to pass another $310 billion of stimulus in this lending program and other stimulus to come. So point being, the amount of stimulus that's going in is tremendous to offset this income loss. The problem is when you look at the bottom, and the problem is implementation of these programs and the time it takes to do it, and quite frankly, much of the U.S., much of the employment is in small businesses. So I know, without going through every one of these charts, and y'all can put an email, I'm happy to send you all this data. But if you look at that table in the middle, any number of companies that are 1 to 4 people or 5 to 9 people, it is so hard, including stories I know of this weekend, to get the money efficiently to small businesses. It'll take some time. And hopefully some larger size required to actually get it done. But the sheer size of the stimulus is pretty incredible. And what I do on the next page is I try and show you some representation of this to show you how big the stimulus is. If you look at the chart on the left side, the top left, this just puts into perspective the amount of fiscal spend that's going in now versus pre-coronavirus. The numbers are it's staggering. And what it's obviously doing, which you could debate for a long time, with the chart on the middle, is it's sending countries into fiscal deficit to fund this, which is, hopefully temporary in terms of how the economy comes back. But I put a table on the right side to show you that if you take the global economy, the amount of money that's coming in as a percent of GDP, just go all the way to the right for simplicity. U.S. putting in 20% of GDP, it's actually going to be significantly bigger than that now. The global economy is putting in 11%. That number is extraordinary. It is extraordinary, meaning while this period is going to be incredibly difficult, the amount of money that's going into it should at least create this economic recovery. We could talk about, how uneven it is and some, quite frankly, some difficult things around it. And just to do it really quickly on the next page, so I don't take too long. One of the things that I think that you don't see from economists oftentimes is we broke down the stimulus and then we looked at the different categories of it to look at how big it is, and then we put on the right side that there's also a multiplier effect. When you put money in, when you take these numbers that are getting in the economy, over 2 trillion of stimulus, which is ultimately going to be over 3 trillion of stimulus, there's a multiplier in certain areas that people don't regard. That's when you get money into some areas, like at the top, when you get it into healthcare, what ends up happening is you create this big multiplier effect, let alone when money gets into healthcare, the other discoveries you make in and around healthcare that Emory, no place in the world is better than Emory at doing that. But if you look at things like healthcare, R&D, infrastructure, what happens is those companies end up putting money to work. It gets into their vendors, gets into other businesses, gets into more efficiencies in the system, and then you get a multiplier effect. So meaning the stimulus is so big, and when you get in the multiplier effect, and again, we could talk for hours about how do you pay for all this. It will put some debt on the country, not just on the country, on the globe. My sense is, particularly in the U.S., and it's harder in other parts of the world, but my sense is in the U.S., the economy is resilient enough and there's enough nominal GDP to pay this down. But it is, and by the way, which I'll finish on in a second, interest rates have to stay down for a long time on the backside of it. Anyway, actually, this is the next page on interest rates. Okay, what does this mean for markets? And then I'll finish with it's a summary of this. First of all, this is policy interest rates on the top in the G7, the Asia Pacific, and Latin America. And I think when people think about their business or think about investing, interest rates are going to be low for a really long time. When you go back to those charts on the prior pages, when you put that much debt on the system, there's no way you could raise interest rates because the burdensome cost of that debt will stifle any economy. So interest rates are going to stay low for a long time, for a really long time, certainly in the US. And then, part of what I put on the bottom that I think is pretty incredible is I just trying to, what's happening, you have an aging economy, not just an aging economy, an aging populace around the world. And we're going through what is a pretty incredible point in time where people are aging, and places like Japan and Europe where the demographics are much older. What it means is people are looking for interest income to support their retirement or support their way of life. Anyway, what I show is the demand for interest rate products, so the people can live off of, and so they've got interest income that buoys their salary or other forms of income. But when you take that demand, those bars are the demand for those products just based on the demographic, the aging of people. And what I map it is in the green line is the amount of products you can buy because the central banks are buying them from you to try and create this stimulus. It means there's not enough bonds in the world. There's not enough interest income in the world, which is the other side of when you borrow. The central banks have to keep rates down, and it's a tricky thing. So one of the things I would think about for a long time is we're going to be in a low rate environment. How you think about your investment portfolio is important relevant to that. Now, when I put on this next page, I know this is maybe a bit dated. I know I've been on a lot of TV shows and media talking about the equity market. The S&P 500, as we said, went from 3,400 roughly to 2,200, and I think the market went way too far down on the backside of it. And I use a series of metrics here, and I know I'm running out of time, so I'll just talk about some of these. One is equity risk premium. It just shows you what the cost, the risk premium built into equities relative to interest rates. And what it shows you on that red circle on the top left is it moved to the point that you hadn't seen. 2011, you saw that, and quite frankly, if you took this graph back, you haven't seen a level like this since the Great Depression. The equity market got too cheap. I would argue, and by the way, that number that over on the screen is 6.5% is now 4%, so it's more normal today. And then the equity market in the upper right, went down to 2,200 and it's since come back to 2,850. I actually am pretty blown away, and if you ask me my opinion today, without going through all my charts on the bottom around how equity market follows interest rates and liquidity, I think the equity market, quite frankly, maybe have gone a bit too far. I still think it's going to go higher over the medium to long term, but I'm pretty surprised it's come this far, this fast. I think it was too cheap, but I know, given the uncertainties, I'm surprised it came back this fast. So anyway, so let's finish with a couple of this to wrap up. And I have, this was from a presentation that was 3 times as long as this, but anyway, some interesting thoughts. You know, would you have believed that a month ago that supply chains in the U.S. outsourced for the last 4 decades could actually come back as America begins to onshore large parts of the economy again? Think about healthcare and how we purchase drugs, et cetera, from the rest of the world, and how technology is purchased from the rest of the world, whether it's 5G or otherwise. Anyway, this is a really big deal. You know, the globalism, I think, is shifting much more to a nationalism, which is a big deal for markets. Second, would you believe that, I don't know if people have heard about this modern monetary theory, is we can just keep borrowing more, and which was considered extremely radical, but now we're actually doing it because we have to do it. Anyway, the key on the back side of this is a series of initiatives that help bring that debt down, which I think is important. 3, universal basic income, albeit an emergency version of it, would have passed legislation in Congress. This concept of sending checks out, which I believe in actually today, sending checks to the broad populace was almost unheard of a month and a half, 2 months ago. And could you believe that happened? And then many of the industries like Amazon is disrupting, pharmacies, grocers, medical supplies would now be considered vital industries of the federal government. Pretty incredible. And to think about the trajectory where they're going. And then, as I said before, the price of oil, I still can't believe this number on my screen. At the price, oh my God, that the price of oil is still plummeting as I speak. And the price of a movie ticket, now the price of oil, because nobody can store oil today, there's no room because because of all the storage tanks around the world are filled. So long discussion about spot oil versus forward versus the forward contracts in oil, but pretty incredible stuff that I never thought would happen. So anyway, there's a series of issues that talk about macro, micro issues that are pretty incredible, how life is changing. Technology and demographics are incredibly important, and a series of things that this virus is, I think, going to change permanently in terms of how business interacts. So in conclusion, I did this last night. It's a bit of a mess, this page. In conclusion, interest rates have plummeted. We're in for a period of low interest rates for a long time. You could write that in ink. That is going to be the case. It has to be the case. Equity markets have rallied back from depressed levels alongside of this extraordinary monetary and fiscal stimulus. I'm pretty blown away. I wouldn't be surprised if they back up a bit from where we are now, but I ultimately think that they're going to go a bit higher this year from where they are. An uneven, uncertain reopening of the economy with hopefully a greater emphasis on health and economic conditions will result in volatile and uncertain markets for a long time. One of the things, there is a which I'll talk about in this next bullet, predicting the reopening of the economy of the coming weeks and months is going to be very hard. And I think people, talking to 3 senators over the weekend, you know, the longer we take to reopen the economy is safer and preferable. But it's also, and I don't know the answer, and not to get in a political discussion about it, the more the economy stays closed, it breaks some of these business structures, supply chains. You know, we do a lot in levered, you know, structures, whether they're REITs or otherwise. But it's incredible because a lot of companies can make it for 2 to 3 months. They can't make it for 6 months, or structures can't. So this is an incredibly difficult political debate about how quickly we open and how do you iterate towards a more open economy. Which there's no good answer to. And then finally, you know, I talk about this in investing and what we're trying to do within our portfolios. We're trying to manage the near term, which is volatile, uncertain, and invest for the long term. And I think people will do well to do that. You know, there are companies, and I've talked about this on TV a lot, there are companies that have come under a lot of pressure that are really good, durable companies that you know, I talk a lot about technology companies, healthcare companies that are worth, some of the consumer companies, consumer discretionary, that are worth owning as a long-term investor. But I think you also have to be thoughtful in the near term because the markets can go down again. You know, if the economy stays closed longer, which is certainly possible, or you get a second wave of the virus. So anyway, what we've advocated to clients is, you know, hold more cash, be more conservative about how you invest, but don't not buy some investments that have come under some pressure that are okay for the intermediate to long term. So Josh and Elaine, I'll stop there, and if y'all have time, I certainly have time to do questions if that works.
Thank you so much, Rick. That was incredibly helpful. We've had a couple of questions roll in around tariffs that were applied to China pre-coronavirus. Do you have any advice on what is going to happen with global tariffs going forward?
So it'd be better if there were easier questions to, I mean, it's, that we talk about that a lot in our business. And I really believe in this concept of we're going to move. And, I'm a believer in global trade works, and global trade is it creates more efficiencies. It keeps the rate of inflation down and it benefits consumers in multiple ways. However, some of the things that have happened in, certainly in healthcare and reliance on other countries for your healthcare supply chain, or things like development of 5G technology for telecom, reliance on parts from other parts of the world, or China relying on the US for parts for their technology build out. I think those things are really hard. And I think there is I think there is going to be much more of a nationalistic intent, certainly for the next couple of years. My sense is, it's hard to see where things go around tariffs near term. My sense is you saw an announcement over the weekend of relaxing some of the tariffs that the president or administration has in the near term. But one man's opinion. We've done a lot of work on this recently. Some of the discussion about where did the virus come from, how is it insulated, et cetera, and what does it mean, relationship with U.S., China. My sense is those things are going to be are going to take on a political, particularly going to the election, are going to take on a political angle to them. And I worry that there are real benefits to open trade, and I worry that could present a problem and create tariffs that are stickier. But we'll see. I mean, we'll see. It's always tricky in an election year, and but I'm not a believer in tariffs. But I understand there's an uneven trade in the world, and this dynamic, particularly around the virus, is going to create some tricky issues.
Thank you so much. Another question's come in. What's the first market you'll look to as an indication that the market's stabilized?
So we look at oil would be a good one today. My God, oil is going to be free shortly. Oil is important, and not so much because of the storage issue and where you clear the spot price of oil. I'm actually on CNBC. It is the worst day ever for oil, and it has to be. It's going to zero. Listen, I think commodities are. We always watch the commodities market, not so much as somewhat because of inflation, but more so as they give you a pretty good sense for demand and how supply demand is clearing in the world, and particularly things like copper is a market I watch quite a bit. China obviously has tremendous demand for a number of the commodities: copper, aluminum, zinc, nickel, et cetera. We keep an eye on those, just get a sense for where industrial demand is. Then I watch the inflation markets quite a bit to see where inflation is. I mean, one of the things that we're trying to keep an eye on is what's happening with interest rates. I think you're going to create longer term inflation. I think the amount of debt that's coming out of this country means you will have more inflation, and I think other parts of the world have a hard time bringing down the debt. You could have inflation come as, not to get too technical, as they monetize the debt. But I think that is something we've got to watch because, like I said, we have to keep interest rates down in this country and the rest of the world. And if inflation moves higher, it puts our ability to reduce the debt or the interest burden on the country as really difficult. So no, I watch those markets really carefully. And for us, from a day-to-day, things we're watching really closely are these jobs numbers, and to us, jobless claims is the one that has become the most prolific for us because we get weekly data. And one of the things that is the most intense today is small business closings, and the ones, how the stimulus gets in and what companies can't make it through, and to get a sense for where those jobless claims start to stabilize and where employment starts to come back. And for the economy, that is the biggest deal, because much of what drives the U.S. economy today is consumer and domestic consumption, generally, including housing, et cetera. And so we're watching the jobs market really closely, more than any other indicator we're looking out for.
That's great. We've got a lot of questions that have come in about what industries are the biggest winner during this this time? Is there any there coming top of mind?
Yeah, I mean, and quite frankly, I think to some extent, we've been big believers in our platform that the structural winners longer term are things that are oriented towards technology or healthcare. The technology and demographics, I think, are hugely powerful. And quite frankly, I think those have moved into hyperspeed today in terms of how they've evolved. So no wisdom in the stock market, I think to some extent, maybe even overshooting on some of those technology names, whether it's obviously the Amazons, et cetera, the Googles, the Apples, et cetera. But technology, continues to be a winner in this arena. Healthcare was growing significantly as the population was aging, and gosh, it's hard to see a scenario where that doesn't continue to grow in many forms, including managed care, pharmaceutical, et cetera. I also think consumer. We look at a lot of these businesses that are consumer discretionary. I still think the consumer coming out of the other side of this is in this country will still be in pretty good shape, and we look at those quite a bit and think that those will be in better shape. And then I think that on the other side it's really tricky around what is some of the heavy industry types of things and are tougher. I mean, we're going to move no matter what. I mean, there's a big debate that we have at our firm and that is happening all across the economy about how do we operate now going forward, and no matter what, there's going to be much more of a virtual, I think, flavor to everything that companies do and think about. And so anything that's in and around that space, I mean, you've seen obviously some pretty incredible, whether it's Netflix or Zoom or some of these businesses that have obviously done extremely well. I've invested in an exercise company called Peloton, and some of these businesses that are more virtual in orientation, you would think would have a more durable growth paradigm to them. We also, from a regional point of view, we're believers. I think the U.S. We think about what's happening in oil now, and energy independence is a really big deal. The U.S. benefits from better technology, but now energy independence. As well as a better demographic than much of the rest of the world. And I actually think China will continue to grow significantly going forward. And what places we're more worried about from an investment point of view are parts of Europe because of the demographic being worse and the debt in Europe being worse. And some of the emerging markets now are going to have a bit of a tougher time growing because they don't have the resources to come back as quickly, and are also burdened by debt that makes it difficult. So anyway, that's where we're sort of aligning from an investment point of view.
That's been incredibly helpful, Rick. Thank you so much. Could you just give us some parting words? What's keeping you up at night?
Well, I don't sleep a lot. So I not only do I not sleep a lot, the markets have been so volatile that getting up at 3:30 in the morning and staring to look at my Bloomberg to see where markets are has made it even harder. But listen, I think the one thing that's that keeps me up at night more than anything else around this, there were things, volatility of markets from a business point of view keep me up, and the liquidity around that at times can be challenging. But listen, there's only one. I mean, I think how the virus plays out and how people recover from it is, it's such a big deal. And like I say, I haven't calls with policymakers all weekend. This is really tough on much of the economy and people in the economy, and obviously from a health perspective, and the way that is keeping me and I think a lot of people up at night, and will for a period of weeks and months.
Yeah, definitely. Thank you so much for your time and for sharing your expertise. This has been incredibly helpful. Thank you to everyone who joined us. This recording will be sent to you later this week. Rick, is it okay if we include your slides with the recording?
Yeah, no problem. No problem at all.
Yeah. Thank you so much.
Yeah, thank you. Thanks, Lane. Thanks, Josh.
Thank you. Have a great day.
Thank you.
Thanks everyone for joining. Thanks, Rick.